Hi everyone, thank you so much for coming tonight. Really appreciate you taking your time out of your Monday night, coming and attending the Young Investors Program for 2023. Today, we're going to talk about the foundation of building wealth. Before we get started, I'm just going to go through the Oriana Financial Services general advice warning. Just letting you know that everything we talk about tonight is general advice only. It hasn't been tailored to your financial situation. So make sure you take that in consideration. It's not direct to your personal circumstance. If you are looking for personal financial advice, feel free to come speak to myself, Costa or Alex after the session, and we'll be more than happy to help. Now tonight, I just wanted to start off by telling you a story about how I got into financial planning. These are my family here. I've got my brother, I've got my mum, and I've got my dad. So basically, my parents were refugees from Vietnam. They were probably my age or younger, and Vietnam was going through a war. And they made the decision to flee their country, to come to Australia for a better life. As soon as they made it here, they had no option to explore career options or anything. They literally just had to work to live. So I guess growing up in my household, my parents were always very money conscious. No matter what they did, they were very, very worried about money and running out of money. And I'll give you an example of this. It'll be the middle of summer, boiling hot. Maybe like the day on Thursday, I think it was last week, where it was really hot. And my parents would not allow us to turn on the air conditioner. So at most, we had like a tiny little fan just blowing hot air at us. And you'd wake up in the morning and you'd be covered in sweat. It just doesn't work. And the same with winter. Like, our house was a double brick home. So our house was like an ice box. It was absolutely freezing. And sometimes I even think it's inhumane how cold this is. It's so cold. And they just didn't ever want to turn on the heater. We had like little bar heaters and stuff, but they just didn't ever let us turn on the heater. And the answer to keeping warm was always just to wear extra layers. Even if you're already wearing 3 jumpers and 4 jackets, it was just wear another layer. So I guess the reason why I'm telling you this is because my parents, building wealth for them was about saving every dollar. However, if you take the lessons we're about to go through with you over the next couple of weeks, you will never have to worry about running out of money. For example, you can feel free to leave the air conditioner on in summer and not have to worry about your electricity bill. Same with the middle of winter, you can feel free to turn on the heater and not stress about, can you afford to? You can afford your daily coffees and not have to think about, can I afford this? Am I going to run out of money? You can even have your avocado on toast on the weekends and you can still afford that house deposit. So we're about to go through the foundations of investments that will set you up for life. If you can understand, let alone master these skills at your age, you will be set up for life and never worry about money. So with that, let's begin.
I'll use the screen.
Sorry?
I said use the screen.
Oh, yeah, sorry. All right, so I'll just quickly talk about the Young Investor Program. This is a consecutive 3-week program run over the next 3 weeks. So today I'll be talking just about the basic financial skills that you need to know to set yourself up. It's a foundation of everything else that we will talk about later in the program. Next week, Costa will talk about building longer term wealth. So things about buying an investment property, buying your first home, and building an investment property portfolio. And then in week 3, Alex will talk about creating a diversified portfolio and what you need to consider in your portfolio. All right, so today's topics are goal settings. As I mentioned in the previous slide, today is quite basic. However, they don't teach these skills in schools, so I do feel like it is important to cover the basics and get the basics right first. Build the correct foundation before you can go on to longer term, bigger picture things. So we'll go through the importance of goal setting, managing your cash flow, starting your investment journey and different ways you can start investing. If I have time, I'll also go through investing within your super fund as well, and I'll just talk generally quickly about investment risk and where you do need to be careful. All right, so the first thing I wanted to talk about today was just the importance of goal setting. Now, I truly believe that setting goals is the absolute foundation of everything we talk about tonight. I do believe that if you can do everything else right, but without having clear goals in mind on where you want to be, then you're just still not going to feel like successful. You may still feel a bit lost at times, and without setting clear financial goals, it just puts you on the right path and makes sure you're working towards where you want to be. And this doesn't just apply to your financial life as well. It can also apply to your career, it can apply to your personal life. The point is, you need to be clear where you're going. And it's not just that, and it's not just thinking about it, you have to write it down as well. Writing it down makes it clear in your mind where you want to go. And to be honest, growing up, I was never great at this. I always had a very, just casual approach to life, like whatever happens, happens, I'm happy to live in the moment type thing. But it's one thing I do regret, and I do wish that growing up in my 20s, I was a lot clearer on where I wanted to go and what I wanted. Because the thing is, one, you'll come to realise that everyone's idea of success is different. People want different things. For example, one person would be like, oh, I want to build a $200,000 share portfolio, for example. Whereas another person is like, I want to travel every year, or I want to be able to do this, or I want to be able to do that. And you'll go through life, and it's important you're clear on where you want to be, because sometimes I think people do get caught up in comparing themselves to others, and that can often lead to envy or jealousy and kind of steer you off or make the wrong decisions. So be clear with where you want to be. And if you have a partner, it's great. I think it's a great idea. You talk about it as well. Make sure you're on the same page. Make sure you want the same things and that you're working towards the same things. So what I do these days is I have a whiteboard at home, and we write down all the things that we want to do. Public speaking was one of mine. But yeah, so be clear with where you're going, and it just reminds you every day, like, are you working towards those goals? You can keep yourself accountable and make sure you're working towards where you want to be. Also, another thing to note when it comes to goal setting as well is the importance of SMART goals. Have you guys heard of SMART goals before? You guys aware of it? Look it up on Google. Now, I don't know if I remember exactly what it stands for. Specific, measurable, actionable, realistic, and time-bound. I think that's right. Sometimes the words are a bit interchangeable, but the point is, be specific and put a time on it as well, so that you know where you want to be by what time. It helps you measure how far you are, how close you are, if you're going to get there. So yeah, create goals, be clear, write them down. I've included a quote here. I think it was by Benjamin Franklin. He says, failing to plan is the same as planning to fail. So make sure you keep that in mind. Sorry, I keep walking to my laptop. All right, so once you've got your goals in mind, the next step is managing your cash flow. Now, the first point out of all this is to have an emergency fund. Now, an emergency fund may be different to everybody, but generally it's about 3 to 6 months worth of salary. It's there to keep you safe. It's there to give you options. If your car breaks down, if anything unforeseen happens, and let's face it, life is unpredictable, it's there just to tie you over. So have an emergency fund. Another point to note is budgeting. Now, I know budgeting can sound tedious or like a lot of work, or just, I don't know, when people hear budgeting, they immediately shut down. So I guess what I want to say about that is reframe it in your mind. You don't actually necessarily have to track every dollar that you spend. You can think of it as an allowance. So, and work it in reverse. So instead of, thinking, all right, this is where all my money's gone after the fact, actually allocate where you want your money to go before it happens. And that's why I make this important point here about automating your banking. And this is what I do, for example. So when I get paid every fortnight, immediately what happens overnight, before I even touch my money, I've got automatic transfers going into different accounts. And by doing that, you're able to allocate funds to different accounts. And it just takes away the work or the brain power needed to budget, because it's automated. You don't have to think about it. And trust me, the older you get, the busier life gets. And the last thing I want to remember every fortnight is to transfer money to a different account. So think of it that way, and allow yourself money that you can spend as well. So you might have, something for long-term investing that when it grows to a certain amount, you invest it. You might have it for daily expenses, guilt-free spending. You might have it for bills and things like that. You might have it for different things. I even have one for my joint account, for example. So I live with my partner and we have an account that has all joint funds. So electricity bills, water bills, house bills, groceries, it all goes to that account. And whenever we're buying things for the household, for example, it comes out of that account. So it's just a very easy way to have a system in place. I guess what I'm trying to say is have a system. A lot of people don't have a system, and if you don't have a system, what happens is people just spend it all. They get the money in their account every fortnight and it just gets spent. So yeah, so make sure you're on top of that. Now, I did put a quote in here as well, just to add on to that topic. And it's a very common quote we have around the building here in Catapult Wealth. And it's like, the money you don't see is the money you don't miss. And what that basically means is, if you automatically set up these transfers, you don't even feel that it's gone. You just don't even notice it. So just get them set up, have it all on autopilot so you don't have to think. Another point with managing cash flow, and I guess these points are a bit obvious, but it is important to go through, is controlling your spending habits. I know for a fact, I go through it a lot. Sometimes when I have a really stressful day, I just go to the shops and I spend money. It's called retail therapy for a reason, So, be aware of that, and I guess be aware of just making spontaneous purchases. Try and avoid it. These days, I have a much better system in place. I think about it a lot before I make a decision. I try not to spend spontaneously, and I try not to spend when I'm stressed. I have a better way of controlling that now, but you definitely should be aware of it, because a lot of times spending habits is it might just be $5 or $10 here and there, but it quickly adds up. This money adds up, and the more you have, the more you don't know where your money goes, so just be aware of that. Maybe audit your recent bank statement, go through your most recent transactions. Where is your money going? Is there anything that you don't need? Is there anything you can cut back? There's Netflix, there's Amazon, there's so many subscriptions you can have out there these days. I'm sure there's things in there that you probably don't need so much. So just be more conscious of where you're spending your money. The other point to note with this is a term called lifestyle inflation. Has anyone heard about this before? Heard this term, lifestyle inflation? All right, I'll just take you through it. There has been a lot of talk these days about inflation, the rising cost of living, for example. But what also happens is the more people earn, the more they tend to up their lifestyle as well, without even realizing. And it's natural. It's actually very hard not to. Like your pay rise might go from 60,000 to 70,000, for example, and all of a sudden you're like, oh no, I can afford to do that. I can afford to do this. I can afford to buy nicer shoes, or maybe I need a new car. I don't really need one, but my friend recently got one. Maybe I'll change my car, or I'll do this, I'll do that. And a lot of a lot of young people do fall into that trap in like increasing their lifestyle as well. So just be aware of that, and that is a trap that people often get into. There's nothing wrong with, you know, buying nicer things and things that you actually need or want, but just be conscious that that is a trap that a lot of young people fall into, and then before you know it, even with a 10, 20, 30, 40, 50k pay rise, they still feel like, I'm not getting ahead, I still don't have enough money to invest, or I don't know why, I don't know where my money's going, things like that. So just be aware. Any questions so far? No? All right, great. All right, so I've just put some quotes up here. Don't save what is left after spending, but spend what is left after saving. Does that make sense, everybody? I think what happens when you're young is, without a system in place, it just gets spent. And people need to think about it in reverse. So, you know, pay yourself first, let that happen first thing when you get paid every fortnight. Put those systems in place, and that way you don't have to think about it. What is left over you can spend, but you've already paid yourself. And the other point to make here is it's not about how much you earn, but it's how much you save. And that's a very common thing young people think. They think, if I earned more, I can do more. Or, you know, if I was on another 10, 15, 20k, then I'd be able to invest, or I'd be able to do other things, or I could do this or that. And that may be true, but often it's not what you're earning, it's your behaviours. Because, and it's been tracked, even people that have increased incomes, they still may find that they can't save, or they just don't have that system. So just two things to be wary of. So is there any questions so far? Is it all making sense? Okay, cool. All right, so now we're moving on to the fun stuff, investing. Now, does anyone have any idea about investing? What do you know about it? Do you have any thoughts or anything? Well, it's probably a hard question. I probably should have phrased that better, but that's okay. Now, the two biggest reasons to invest is first thing is inflation you need to be aware of. Does anyone know the recent inflation numbers? No? 7.8. Okay, well done. Correct. Yeah. The rising cost of living, it's in the news everywhere lately. You can't get away from it. It's everywhere. Normally the RBA aims to achieve a 2 to 3% inflation rate. In the last couple of years since COVID, it's through the roof. It's 7.8, it's tripled, doubled, it's going up. Things are going to get more expensive. And essentially what that means is, if your money's not achieving 7.8%, your money's going backwards. And I'll give you an example of really conservative people. For example, I know some people that are really conservative may come from countries where the banking system is corrupt, or they don't have a stable banking system. What they sometimes do is they take money and they put it under their mattress, under their bed. Have you heard that story before where people do that? So basically that, from an inflation point of view, that's a terrible thing to do, because that $50,000, which may be laying under your bed, for example, that money is going backwards. If it's not achieving at least inflation, that money is not growing. And, you know, at one point in time, that may be able to afford so many things, but 5 or 10 years down the track, you're not going to be able to buy as many things. So that's a big reason why we need our money to keep up. The second thing is something called passive income. Has anyone heard of passive income before? Yep, all right. Basically, passive income is income that you earn while just asleep, basically. You don't have to work for it. And it sounds great because, you know, it's there, it's in the background, you don't have to do anything. And, you know, as you're starting off your career and you're thinking, yep, you know, I like my job, it's all good. The reality is, we can only work so many hours in a day. And there will come a point in your life as well that you can't work forever either. So passive income is a way to create a second source of income, but it's an income source that you don't actually have to work for. So you've got your money growing there, it's paying you income, it may be growing as well, so things like that. So that is why investing is important. Now, the point with investing is these days there's a lot more options available that weren't available in my time, and I wish it was, but these days it's really accessible and young people can get started with as little as $5. You don't need a lot of money to invest, and nowadays they've got these things called micro-investing apps that you can simply log on to an app on your phone, download it from the App Store, and it would be like a little quiz or a questionnaire that you have to do. It puts you into a specific risk profile or category, and then it invests your money for you. The beauty about micro-investing is that it's easy, anyone can do it, and literally you just need $5. It's great for people also that don't really have that system in place where they're automatically, investing regularly. So you've got roundup features, and roundup features are like, you might buy a coffee for $4 at the shop, and automatically your transaction will be rounded up to the nearest dollar, and that dollar is then invested in the share market. So it's done daily as well. So you don't even have to think about it, and it's just there. The other benefit of it is as well is that you can easily set up automatic investments, and that's great for dollar cost averaging and just taking the emotion out of investing. I think a lot of people sometimes get scared off, and I know I'm not perfect. I do invest, but sometimes I'm like, it's not that I'm trying to time it, but I'm like, oh no, it's probably not a great time right now, or like the ups and downs of the markets do start to affect you. But the thing is, when you're young, you have to remember to play the long game, and I will go that into more detail in the next couple of slides. So yeah, does anyone have any questions on micro-investing? I know that there's been plenty of questions previously. Does that make sense? Is there anything else you want to know about it? Yes?
Do you know if there's a crossover between those micro-investing apps and then getting into the market using an EFT?
Yeah, good question, Costa. Yeah. So micro-investing is relatively cheap to run. They all have slightly different fees. Generally, it's like $2.50 or $3 a month, whereas you can go direct as well, and there's going to be no fee on that. I've done both, and I eventually closed my micro-investing apps because I knew how to invest directly with a brokerage account as well. But it really depends on your preference. Depends if you want to go through this really user-friendly way to invest, or if you'd rather go direct, because if you feel a little bit more confident, you know what you're doing, you're like, I'll just go direct and then save the platform fees. So there's pros and cons of both, and before you do pick up a micro-investing app, definitely do the research and look into what you find would suit you. The most common ones in Australia is Raise and Spaceship. Those are the two most common. I think Shares is another one as well. Robinhood doesn't actually exist in Australia yet, but you would have heard a lot about it because it's a very big app in America. And you've also got like Six Stockpot. There's so many out there, and honestly, there's more and more coming out all the time. So yeah. The next point I'll talk about is just what Costa was mentioning. You can also invest directly as well via a brokerage account. Now, I'll tell you which one I'm using. I don't have any preference of anyone or anything, but I do bank with CommBank. So I guess when I wanted to start learning how to invest, what I did was I just called up CommSec, and I literally didn't know what I was doing. I was just like, I want to open a share portfolio. How do I do that? I guess because I wanted to learn about investing, and one of my best tips about investing is just go out there and do it. Like you just gotta go out there and do it. I'm not a fan of like reading books or thinking about it. I just want action. So I literally just called them up and said, I want to open a share portfolio. How do I open an account? And that's how I came to invest with CommSec. But Look, there's so many options out there available. I know if you bank with ANZ, they have an account. NabTrade, they have an account. Self-Wealth is one that's a low-cost one. I don't know how well they work in terms of functionality, but I've heard great things about it. There's so many options out there these days that you can choose from. And on these accounts, generally, you can buy things like exchange-traded funds. These are some of the investments you can buy: listed investment companies, direct shares, also known as stocks, for example, or direct equities. Those are some options you can buy on the share market. Do you guys know the difference between these types of investments at all? No, that's fine. I'll take you through them. Now, an exchange-traded fund is like a basket of shares. So you're buying the index, but you can choose different themes, which is a really good thing about exchange-traded funds. And going back in time, if I had known more about them, I probably would have started off with that. The beauty of buying an ETF is you don't need to think about specific stocks. Sometimes people think that being an investor, you need to know how to do all the company analysis and, you know, look into Woolworths and understand their specific charts and things like that. Trust me, I don't do any of that. I like to keep my investments simple. And so exchange-traded funds are a great, even listed investment companies, for example, they are a great way to get started when it comes to investing. I know Vanguard is a really big common one. I'm not sure if you guys have heard of before, but they're a very big exchange traded fund, and they're really low cost too. So you can buy in different themes, you can buy ethical investments, you can buy global 100 investments, you can buy Aussie top 200 investments. The point of the matter is you're buying a certain theme or a certain index. And the beauty about it is that you don't need to stock pick. You don't need to think, I want to invest, but which stock do I buy? Woolworths, Coles? Like, you know, there's so many options out there. If you believe the domestic economy is going to do really well over the next 5-10 years, you just buy the ETF and it will get you the returns. The beauty of an ETF is that they're always being updated as well. So as companies drop out of the top 200, new ones come in. So you just don't have to stress. And it's a very simple, lower risk way to invest. You've got managed funds, for example, as well, where you've got a fund manager. So you can buy units in a fund. And so basically you've got a fund manager controlling the portfolio and making investment decisions for you. They do tend to be a little bit more expensive because you've got a fund manager. You don't actually have to pay for it, but the fee comes out of your investment earnings. The beauty of that is that they say with a managed fund, your returns should be better because you've got a professional fund manager making investment decisions behind the scenes. So if the market's going down, technically a managed fund should perform better because there's someone there making the investment decisions and, you know, tweaking the portfolio on where they see the risks are and things like that. But not to say that's the fact either, because a lot of fund managers also get it wrong. There's a huge debate between passive and active investing, and it really comes down to personal preference. If you like it all or you can't decide, you can invest in it all and just see what you feel and what you feel is, you know, right for you. And then there's direct shares and stocks, which I won't go on too much about today, just because I'll keep it very basic and high level. But if you come to session 3, Alex over there, he'll go into a lot more detail about how you can build a diversified share portfolio and just go through growth stocks, income stocks and things like that. But basically, or to put it simply, direct shares is like a piece of a company. So, for example, if you buy Woolworths shares, you own a piece of Woolworths. It may be 0.00001%, but you still own a piece of Woolworths. And what happens is, if they make a profit, they pay you a dividend. So you can receive a part of their income. I always thought it was kind of cool. I was like, wow, like, you know, you can own all these public cool companies. And if you do have companies in mind that are on the stock exchange, you know, you can think, you know, like, I really believe in this company, like, I really think they're going to do great things, you know, and that's how you can get invested along their journey as well. Direct shares can be riskier because obviously There's a lot of risk with investing, but direct shares, being that you're exposed to single companies can go to zero. So you have to keep that in mind. Things might not go so well, investment earnings may be missed, maybe there's another pandemic. Who knows what will happen? Like, direct shares tend to be a bit riskier, but they are there as well if you are interested. Any questions so far? Does that make sense?
You said with micro investing,
yeah,
that you can start with $5 or have a small sum.
Yeah.
Is that something you can do with like on those types of apps as well, or is that something you have to have a little bit more money?
Oh, do you mean the brokerage accounts?
Yeah.
Generally, with brokerage, I'll give you an example with CommSec. One trade is $20. So generally you would need a decent amount of money to make that not a waste of money, I guess you could say. I don't know what the minimum is, but I think generally maybe $1,000. You could buy investments with $1,000. But the thing with that is the brokerage costs. And yeah, just to be aware, because that can become expensive and chew into your gains as well.
Just on that,
yep.
I do know that there's some brokerage accounts that have like premium membership subscriptions that you can pay for as a once-off fee.
Oh, cool.
That give you the option to have lower brokerage fees and lower payments per trade.
Yeah.
I think that's another.
Yeah, and it's a good thing you mentioned that, because I think this space is continually improving. Like, for example, in America, Robinhood, I believe, have zero brokerage, and it sounds great and might come to Australia one day. The fact is, it's becoming more popular, and so I have no doubt in a couple of years' time, there's going to be some other competitor that comes through and says, no, we offer 0% brokerage, blah, blah, blah. So just always weigh up the costs as well, because there'll be a cost to that, or there'll be another side to it. So you just weigh up, how often do you place trades maybe? Is the membership fee worth the cheaper brokerage or the free brokerage? So things like that. But yeah, it's a continually evolving space, and especially in the last 5 to 10 years, it's changed heaps. So just keep that in mind.
Sorry, and do you want to just explain what brokerage is?
Oh, yeah.
A little bit more detail?
Yeah, for sure. Does anybody know what brokerage is or doesn't know what brokerage is? No? Okay. It's basically the cost of placing a share trade. So when you buy a share, it may cost $20. And then when you sell a share, it may cost $20. Now, I just quote $20 because I know that's what CommSec charges. But it depends on the trade value as well. But it's basically the cost of buying and selling. So, yeah, have I covered that question? Yeah. All right. Cool. All right. Now, I just thought, what would an investment presentation be without Warren Buffett? So I've included one of his quotes here. He says, today, people who hold cash equivalents feel comfortable. They shouldn't. They've opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. So that demonstrates the importance of investing. You want your money to grow. And, I am very conservative myself, and I do consider myself not a high risk taker. I think my friends recently rated me a 3 out of 10 in terms of risk taking. However, there is a cost to not investing. And I've come to learn this over time, that you may be too afraid to start, maybe you're afraid of losing money. And that's a very common thing, because it's your hard-earned money. You've worked really hard for it. You don't want to lose it. But the problem with that is, if you don't take that leap and you don't invest, that ends up costing you a lot more in the long run. We talk about brokerage and the cost to invest, but over the long run, if you don't invest, and I'll show you a chart just in a second, it ends up costing you a lot more. So that's why we're here tonight. You guys need to understand the power of investing and what that can do for you. Now, the chart's in the next slide, but I'll just go through some basic investment principles and touch on that topic again. All right, cool, we're going good for time. Now, these are just some important points to note when it comes to investing. First of all, diversification. Does anybody know what that is? No? Okay.
Put all your eggs in one basket.
Exactly right. got that photo right there. It's just the basic way of managing risk. You've got different asset classes. You've got, fixed interest like term deposits. You've got cash. You've got shares, domestic equities, international equities. You've basically got all these investment classes. You want to be able to spread your risk across all the classes, because we're not about trying to pick and choose which investments we think will do good one year and not good the next year. It's just manage your risk by diversifying across all the asset classes. You've got defensive assets and you've got growth assets. So no matter where the market goes, you've got your investments or your capital spread across multiple areas. Another thing people often think about investing is that it's like it's a casino or it's like gambling. A lot of people that don't understand investments often think it's like day trading. And I don't know if you've ever paid attention to like the news, GameStop, Wall Street bets, meme stocks. I don't know, I don't dabble with any of that, but I've heard like my friends talk about it, and a lot of that is really short-term speculative trading. That's where a lot of people go wrong, because as advisors, we're about long-term investing and building long-term wealth. The day trading, that's, I think this stock will quadruple within, things like that. We're not about making short-term investments and getting in and out of assets quickly. We're about investing for the long term and building long-term wealth. Another thing to note when it comes to investing is it's time in the market, not timing the market. And I know that's easily said than done, because I know I've done it before, and I'll give you a story about when I was younger. I was working for a financial planning firm. All the advisors and analysts there were on the investment committee, and we would talk to the fund managers and talk about where the economy was going, where they thought shares were going, where things were going. And I guess being part of this, I was like, oh great, I can change my investments and make this work in my favour. And what I've come to learn is, doesn't matter if it's, doesn't matter who it is, doesn't matter how qualified they are, no one's got a crystal ball, and we see it time and time again. People often get it wrong, and so I would highly discourage you to try and time the market or try and time your investments. I remember sitting in like my super fund. I was with Rest Super at the time, and I would be like, okay, these asset classes did well, all right, and this is where they're saying the market's going to go. I'm going to change my investment options. And honestly, that is the worst thing that you can do, because you're constantly changing investment options. There's costs to that as well. And that's the thing that people don't realise. You see all these costs coming out of your super and you think, what the hell's going on? So I think what people need to realise is that it's time in the market that counts. It's not timing the market. The market is unpredictable, and you never know what's going to happen. We could have another COVID situation and the market could drop another 40%. Nobody has a crystal ball. It doesn't matter how qualified they are. It doesn't matter how many degrees they've done. Nobody knows what's going to happen. So understand that. But at the same time, I will say, that's easier said than done. I know people still do it. It's very common. You think you want to get in a good time, you want to get a good deal, I get it. But it's very hard to do. So the more you can try and remove the emotion out of it, the better off you'll be. The other point to make is the importance of dollar cost averaging. Now that's the same as not trying to time the market. The beauty of dollar cost averaging is you're frequently putting in money into the market. You're removing the emotion from it, and you might set a goal to invest $2,000 in the market every 3 months. Something like that, it just removes the emotion. The market could be up at the start, it could be down, it could be sideways, who knows where it'll be. But the fact is, you're committing to a regular cycle of dollar cost averaging and entering the market. It removes the emotion, but it also averages out your entry point. So you're not trying to get it perfect and you're not trying to time it right. And then there's also the point about investment compounding. Now, investment compounding is the idea that as your money starts to grow, as you start to earn income, you start to earn growth, things like that, if you don't need the money while you're young, tick to reinvest your dividends back into the portfolio. The benefit of that is that you don't have to pay for brokerage, so you're saving there, but at the same time, any income that you're entitled to, it's just reinvested back into the portfolio. You don't even have to think about it. It's just growing there in the background and doing its thing. So do I have any questions? Does that make sense so far? I know sometimes I do talk a bit fast, so if I'm going a bit fast, do let me know. Okay, so this was the graph I was referring to earlier, and it just kind of points out the point to invest for the long term. Now, the CPI rate is here, average of 2.4%. You've got the cash rate as well, and then you have these Australian shares, US shares, listed property and things like that. And a common analogy we use around a catapult wealth is about the man walking up the hill with a yo-yo. So the yo-yo is the ups and downs of the everyday markets. One day it's up 2%, the next day it's down 2%. It's yo-yoing all the time. But what you need to focus on is the man walking up the hill. Over time, he will continue to walk up that hill. Don't focus on the short-term ups and downs. A lot of people get fixated on that. And an example of this is checking your portfolio every day and just saying, oh, look, I've made $200 today. Oh, I've lost $500 today. Things like that. That can drive you crazy. So, for example, I don't even look at my portfolio anymore. I just trust in the process and I trust in the long-term investing. As you can see, the markets will never fail to go up and down. And the important thing to note as well is one asset class won't necessarily be the best performing asset class the next year. Like, it may be the best performing this year, but not the next year. So that's why diversification, time in the market, things like that, those are things you need to remember. Think long term. And I guess a point I also want to make with that is that for you guys, because you guys are young, you guys can afford to take investment risk. You guys have a lot more time to ride out any downturns. If you invested your capital today, let's say you've got $5,000 and you invested in the market, and then the market dips by 30%, you've got time for that money to recover. You're not gonna, unless you're saving for a house deposit, in that case we probably wouldn't recommend you investing it in any growth stocks or anything, but it's still good to actually at least put it in a high interest account or put it in a bit more of a conservative investment. But unless you're saving it for a specific purpose where you're gonna need the money within a year or two or three, you will have the time to ride out any downturns. For young people, they've got a huge opportunity ahead of them. And I guess one point or analogy I'll make is when there is a market downturn and the market's down 30%, like during COVID, you have to think of it as a Boxing Day sale. Boxing Day sales, people lining up in droves, trying to grab bargains. That's what you want to think about when it comes to your investments. Because unlike Boxing Day sales and consumer items, for example, these are assets that will grow over time. So that's when you want to get in. A common misconception is that people think the market's down and then it's like they stop believing in the market, or they just think, all right, maybe this is the end. Maybe the share market's finally going to crash. Maybe it'll drop lower. I'll get in when it drops a little bit lower. Things like that. You have to think, if there's a market downturn, that's a great time to get in. And being young, you have the time to reap the benefits from it. Yes, there's maybe a bit of risk, as there is with risk with investing, but market downturns present a really good opportunity for you guys to get in. Does that make sense? All right, cool. The next slide I wanted to talk about is the potential returns you can earn from investment compounding. I mentioned earlier that if you don't need the income from your investments, definitely tick the dividend investment plan, because by doing that, your money is growing at an exponential rate. not only is your principal now earning money, the interest on that is earning money, and any additional income you're earning as well is also growing. That is the key to long-term wealth. We've got time to wait, and we've got time to let it keep growing over time. And as long as you're adding to it, your money's being reinvested, you've got time to ride it out and let it grow. And one way I like to think of it as is like a snowball. You know, you first off start off, you know, with something really small, and it feels very slow, I guess. Like, you know, you might just get a $5 dividend, or you might just get, you know, your returns feel very little. But over time, it starts to grow and grow and grow, and to the point that one day it's growing so big that it just trickles. Like it's you know, it just gushes. So keep that in mind and reinvest your income where you can if you don't need the money to live off, and just let it continue doing its thing. Does that make sense, everybody? Cool. All right, now, because we're talking about investments today, I thought I would also touch on the topic of investment risk. And I think one of the most perfect examples of where people can blow up their money and totally ruin themselves financially is by taking unnecessary investment risks. And the best example I can talk about this is with cryptocurrency. Cryptocurrency, I know, is probably something that you guys have heard about. It's a very millennial thing. It didn't exist in my time, but it's something that's always been on the news. People are always asking me, you know, what do advisors think of cryptocurrency? Are we going to recommend it to our clients in our portfolios? You know, is it the new thing? Is it where we should be putting our money? The truth is, some people have made money from cryptocurrency, but there's also a lot of people that have lost lots of money from cryptocurrency. Cryptocurrency is a very speculative asset, and it's like the short-term trading and gambling that I mentioned earlier. The asset value is very volatile, and things can change at any given moment. One thing I wanted to talk about on that is just this concept called the greater fool theory. And I think have a look at it, look it up online if you haven't heard of it before. It's something that drives up values of assets or investments like crazy. One person may be willing to buy an asset at a certain price, and then somebody else is willing to buy it at an even higher price. Maybe there was news about all these advancements. Maybe there was speculation about how it's going to change the world and it's going to be this big, massive thing. At the end of the day, just because they're willing to pay double for that asset doesn't mean that asset is actually worth more. Because the thing is, people see the value of cryptocurrency constantly rising and they think, my friend's getting rich off it, I want a piece of that. What's everyone talking about this cryptocurrency? Everyone's making money off cryptocurrency. Things like that. You have to be aware that things like investments or assets like cryptocurrency are extremely volatile. And the worst thing you can do if you do decide to put money into it is to risk serious money. Some people get so caught up in trying to make it big or trying to make it rich off these risky investments, they will take out a reverse mortgage on their home loan and place it on basically like a bet, you know. So just know that that is one surefire way to risk losing it all. I guess another point with cryptocurrency is that it's all speculation as well. No one knows where it's going to go. And I don't know if you've paid attention to the value of it as well. Like, you know, it's dropped, I think, it's more than halved. It's like down to 20,000, 30,000 these days. The point of the matter is it's extremely risky. So avoid it if you can. But if you really feel the need, you want to dabble in it, do not ever invest serious money. Don't risk anything. Put money in that you're willing to lose and just think of it as lost money if you absolutely have to put money in it. But just be aware that it's extremely volatile and risky. So don't think of it as a serious investment. It's at the same time, I have to say, like, it's easy to get caught up. You hear your friends talking about it, you hear the news talking about it. I totally get it. And, you know, it's seeing people make money off of it as well. remember, you've got your goals, everyone's different, everyone wants different things. Go back to what you're trying to achieve. All right, do I have any questions so far on anything that I've gone through? Okay. Now, I'll just touch on investing within super as well. I mean, I could probably talk about this forever, but is there anything anyone specifically wants to know when it comes to investing within super?
Is it
Yep.
possible to invest in specific shares through super?
Sorry?
Is it possible to invest in specific shares?
Within super?
Yeah.
No, that's a really good question. And the answer is it depends on your super fund. However, these super funds most days do allow that option. I'll basically guide you through the differences between the super funds. You've got industry super funds such as Rest, UniSuper, Australian Super, for example. You've got retail super funds like Colonial First State, BT. Now, those super funds are owned by the banks, so often you have a lot more investment options within those super funds, whereas industry super funds generally tend to be more basic. And then you've also got self-managed super fund, where you can invest in anything you like. You can invest in cryptocurrency, for example. You can invest in gold and silver. You can invest in motor vehicles. I know a guy in the building, he's got a car in his self-managed super fund. You've got full investment flexibility. Whilst you're young, I'd say keep it simple, because you want your balance to grow, and your needs may change over time based on your investment preferences. However, back to your question, these days, Australian Super and a lot of other super funds try to be competitive with self-managed super funds. So they might have found a lot of people leaving Australian Super because they're like, I want to invest in a specific ETF, or I want to invest in BHB or CBA shares within super. And so what they did to remain competitive is they're like, now we've got an option that our members can invest in specific shares. You can even buy term deposits. They've extended out the options to include more things. I don't know them all off by heart, but I know that, for example, I'm with Australian Super, and I know that if you go through their member direct option, there's an additional fee or an additional charge, but basically with that gives you options to buy a lot more investment options. If you don't go through that method, then there's the just the general options that are available. It's tend to keep very basic, but that's fine. There's nothing wrong with basic. There's premix options, where you've got conservative, you've got balanced, you've got high growth and things like that. You've got asset class options. You might have international shares, you might have domestic shares, you might have cash and fixed interest and things like that. That's a bit more of a DIY approach, where you're like, you know, I want to create my own asset allocation and, you know, kind of customize my investment strategy. And then sometimes you might also have like lifestyle options, where you're like 90s or 80s investment options, where they kind of, it's like a growth option while you're young, but then over time it becomes more defensive, so it's automatically rebalanced for you. So those options are great as well. And then as I mentioned earlier, if you go through like retail funds, they often have a lot more options, where you can invest in ETFs, you can invest in direct shares, you can invest in managed funds. You've got a lot of options available for you, but generally because of that, they might be a bit more expensive as well. When it comes to super, there's no one size that fits all. And often someone might say to me, what's the best super fund? It's not a simple question to answer, because everyone wants something different. And, you know, you could want simple and low cost, and that's, you know, that will give you your options. Or you might want more investment options. Maybe you want ethical investment options. I know that's very common these days, whereas, you know, the simple basic ones may not have those ethical options and stuff like that. So it really depends what you're after and what is the best for you. So there's no one size that fits all. Now the other point I want to make about superannuation is this, to do with this point here, that I had to put it down just to remind me to talk about. The younger you are, the more you can afford investment risk. And what I'm trying to say is, when you're young, we've got 30, 40 years to ride out any downturns. Don't be conservative with your superannuation investments. Don't you might hear on the news that the market might drop 30% and think, oh, I should be proactive with my super. Maybe I should change it to cash and just so it doesn't drop any further. That is the wrong move. Like, it's very hard to time the market, as I was saying. And you may change to cash and it might go back up, but then what often happens is you're still stuck in cash. So it's very hard to time, and try not to overcomplicate things. Stick it out for the long term and choose a long-term investment options. And an example of that is a lot of our clients, they might stick in a lot of growth or high growth because they understand that over the long term, they've got a 20, 30, 40 year time horizon to ride out any downturns. So keep that in mind. The younger you are, the more you can afford investment risk. The more you can take advantage of the opportunity you have of time to ride out any downturns. So I know it's great trying to be proactive and trying to keep on top of your super fund and try to, do the right thing, but at the same time, that can be a biggest drawback as well, and you can end up stressing yourself out trying to time yourself back in and thinking, actually that reminds me, another point I want to make on that is, for example, let's say the market's dropped 40%. So your $50,000 portfolio is now down to 30,000. Thank you for that. 30,000. What people often think is they've lost $30,000. Is that true or false? Does anyone know? Correct. You actually haven't lost that $30,000. They see a negative 30 and they freak out and they think, I've lost $30,000. You actually only lose it when you sell your investments or you change your investment options because you're selling out of that investment. So the point of the matter is, you see that negative number on your superannuation statement, fear not. It's just a paper loss or a paper gain. It's not until you actually transact and sell out of your investments that you crystallize that loss and you make it permanent. So that's another common misconception. And I have this talk with my uncles, for example, and my parents all the time. They just think, I've lost money. It's like, no, you actually haven't lost it. It's just a number. It fluctuates every day. And don't get caught in seeing that negative number. It's not lost until you actually sell your investments or change your investment options. So keep that in mind when you're looking at your super fund. All right, so that kind of wraps it up for today. I have 3 minutes left, so I guess I'll just summarise my presentation. 1, set clear financial goals. Be clear where you want to be so you don't get lost trying to compare yourself to your friends or to other people, but you know where you want to go and you can focus on your own journey. Build good habits early. The younger you are, the earlier it is to set it all up so you're on the right track from the get-go. Automate your banking and investing where you can, leave it on autopilot. The older you get, the busier life is going to be. So have it just work in the background without you thinking about it. Set up the automatic transfers or the automatic investments so you keep it simple. Don't get caught up in lifestyle inflation. The more you earn, people naturally just start to spend more. But just be aware that that can easily rob you of your ability to be able to contribute and invest. Contributing to your super, investing in growth assets. That's what you want to be thinking about with every pay rise. Start small if you're nervous. I didn't get to touch on it too much tonight, but you can get caught up in trying to be perfect. The fear of losing money is real, and I totally get it. You work really hard for your money. But if you're really nervous about investing, and it's completely understandable, start small. So maybe micro investing is great because you can suss out your attitude to investing and you can actually kind of learn how you feel along the way. When the market's down, how do you feel? When the market's up, how do you feel? You just, baby steps. So that's a great way to start. Stay consistent. It doesn't matter whether the markets are up, down or sideways. Stay consistent and keep to a long-term strategy. Diversify your investments. By diversifying, you're diversifying your risk across different asset classes, and you don't have to stress too much about what asset classes are winning or losing that year. Your capital is spread across all the asset classes. Now, the final tips are Think long term and don't get nervous over everyday volatility. When the market's down, it presents an opportunity. It's not something to be feared. The younger you are, the more you can afford investment risk. And I know I've said that several times tonight, but that's because you guys being young, if you guys understand that and can master that, you are in the prime position to take the most advantage of it. Don't aim for perfect, suss it out along the way. Don't get caught up in the fear of losing money. We all learn from mistakes, and you're only gonna get better with experience. And that brings me to the last point. The best way to learn is just to do it. I could give you a lecture for 8 hours. I could, give you all the books, the investing books out there. We could give you all the resources in the world. But at the end of the day, you're not going to actually really learn until you go out there and do it. So don't be afraid to start, and we're here to help you along the way as well. So good luck. Hope you got a lot out of this session. Feel free to stay back if you have any questions. We have a Facebook page and a LinkedIn page. And I also encourage you to join our Facebook Young Investors group. I'll get Megan to send out the link after the session. If you join that group, we'll constantly post content on there to keep you updated and in the loop. And it's your chance to liaise with the advisors as well if you have any questions along the way. Maybe you've started opening your micro investing app and you'll have some questions or you're stuck on anything. It's your chance to speak with a financial advisor and we can steer you on the right path. So definitely join that if you can.